which are our core carbon principles, 10 principles that really define what a high-integrity market should look like, and an assessment framework, which gives it life, because you can have principles are great, but unless they can be applied in practice and vetted, you can't be sure that you're getting the quality that you need. And from our perspective, the good news at the Integrity Council is, regardless of all that you see going on in other areas, on the supply side, I believe that our standards are being recognized as the international standard that everyone should be applying. And it's been very gratifying. I mean, even the US government, which had really been sort of lying low on carbon credits for a long time, and in May, the Biden administration, through Secretary Yellen and the heads of the Department of Agriculture and Energy, as well as the White House, came up with a document that said, this is what we think high integrity credits would look like. And of course, they pretty much mimicked or aligned themselves with our core carbon principles. And then they said, we believe that the Integrity Council is doing this is what they're doing, and that done with integrity, carbon credits can meaningfully contribute to our net zero goals. That was a tremendous accomplishment. And then you saw last week that the CFTC likewise came out with guidance for exchanges that will trade futures on carbon credits. And likewise, they looked to principles remarkably similar to ours. Plagiarism is a great thing. And then also recognized us as a sort of industry recognized standard, saying that if exchanges decide to trade futures on carbon credits, which we certainly hope will happen at some point if there's enough liquidity in the market based on our work, and that when they do, to ensure that those listed futures are high integrity, they can use as a very important tool in making that determination. They can look to the Integrity Council's core carbon principles.
And you already touched upon it, but the approach that ICVCM has taken is almost that of a regulatory body. And we saw it in the CFTC. I mean, I think you guys are mentioned basically on every other page as an example of something that market participants and DCMs in particular should look to. How close is the coordination and cooperation and dialogue between yourself and the CFTC and IOSCO and other?
Yeah, I think it's been our cooperation with the regulators has been, I think, a model for how cooperation should be. I think they have been very supportive of our work. Obviously, my background as a regulator, sort of prejudices me in terms of what I think the best approach is. But I do believe that relying on regulatory principles in coming up with our core carbon principles has been key to getting buy-in from governments and regulators. What we've really tried to do is follow a process that's akin to a regulatory process. So we went out with full notice and comment of our proposals. All of the comments were published on our website. When we came out with our final CCPs and assessment framework, we, again, very public and transparent about it, but also explained why we came out where we did. And our hope is that ultimately, look, as you know, the private sector is engaging in this effort because governments have not really addressed all the issues that need to be addressed. But that's not to say that we don't hold out hope that at some point a lot of these processes do become governmental processes and more regulated. And our hope is that if they do, that what we have done is so consistent with what regulators would have done, that if they took it over, it would be a relatively seamless transition with very few changes and hopefully minimal market disruption if it did become part of the regulated market.
Thank you, Annette. And Nat, so with the ICVCM looking at this more from the supply side, I mean, how does the CTUS look at this in terms of utilizing these principles to then further drive the demand side of the equation?
Well, thanks, and thanks to Xpansiv for hosting this terrific conference and for having me on the panel. It's really a pleasure to be on with Annette and with John as well. So I think, when I think about what we need to build a market at scale, to build the voluntary market up and make it robust and deliver the kind of finance that I think we think it has the potential to, I know we'll come back to some of that later in the panel, but you really need integrity. I think we've said for a long time, you need integrity on the supply side, you need market integrity in terms of how the market itself works and transparency, and you need integrity on the demand side, meaning in how the credits are used. So I'll dig into that a little bit. But I do think, I think ICVCM, the mission and the vision behind ICVCM was to provide that clear benchmark quality standard for integrity on the supply side. And I think Annette as chair and Amy Merrill as CEO have done just a tremendous job with the expert panel and everything else. So I think on the supply side, ICVCM has that really down. I do think and I guess I should say in the middle, in the market integrity piece, I think frankly, much of that will happen as Xpansiv and others know how to do that, right? There's some folks out there who are working on making sure we have all the infrastructure, but I think that's going to happen. On the demand side, I think that's the piece that's a little bit harder. And what do I mean by that? Well, I mean that you do need, I think, clear rules of the road and norms that people say, okay, here is the way that companies can appropriately use credits, if we're talking about the voluntary market, can use credits towards their voluntary climate strategies. I think there's broad agreement at a very high level that you clearly don't want companies substituting credits for emissions reductions they can make in their own inside their own operations. But I think there's still a lot of work to be done in figuring out, okay, but there should be a role I think for credits. I would say there should be a role for credits in helping companies meet their climate commitments. One great example of this, I wouldn't limit it to this, but the role of credits for Scope 3. I'm sure this is a sophisticated audience, but Scope 3 being all the emissions that happen in a company's value chain, their suppliers and also downstream in their demanders. I think particularly in the company's supply chain, those are very hard emissions reductions to achieve directly for a company. And there are a number of instruments, carbon credits and some other sort of related market instruments that actually can help, I think, companies make investments in reducing the emissions, and especially among their suppliers. So I think we ought to take advantage of that and use it. But right now we don't have the clear rules of the road for that. We don't have clear norms. I think the Voluntary Carbon Market Integrity Initiative, VCMI, is doing a great job of trying to establish that. But this is an area where there's a little more fragmentation. You've got SBTI out there with a sort of Scope 3 process that is going along. GHGP plays an important role. So I think we'll be able to get it done. I think we'll be able to provide the kind of clarity. But what I think, certainly the companies that we speak to, they say, look, if we're going to use carbon credits, first of all, they need to be absolutely high integrity, and they look to ICVCM for that. But they also need a business case to use them. It can't be simply charity, can't be philanthropy. If it is, they'll write a check that maybe has 4 or 5 zeros after it. But if it's a business case and it can help them meet their climate strategies, we hear from companies, then they'll be thinking about finance in the millions, and that's the kind of finance we need to make a difference. Collectively in the billions.
Mm-hmm. And building on that, so John, in terms of the supply side and the demand side, how is the infrastructure in the marketplace today? So what is the current state of the VCM market infrastructure, and what needs to improve in order to scale and meet the energy transition needs?
Yeah, well, I think that we look at the VCM like any other commodity class. It has some differences, but got to treat it like the same as you would treat in any other energy class or agriculture or any other commodity. So from the very beginning, we set out to build the infrastructure that we thought was necessary to support that. There are some unique things, because they're actually, at the end of the day, people are transacting the absence of something often. So it's a certificate, but that's really just the function of delivery. So with us, the way we thought about it is to build out the robust registry infrastructure. So we've supported the standards. We're not in the business of saying what qualifies or doesn't qualify into a program. It's not our strength. But we do work with the large standards to help build an infrastructure for them that supports their ability to do that. So I think that's quite robust. There's still some work to be done around the earlier panel around Article 6, how these things connect with one another. How do you make sure that you have transparency across all these transactions? But then along the way, how do you connect those pieces? So we worked real hard on that and opened up our infrastructure to other parties, other venues to transact. And I think to Nate's point, Nat's point, the market infrastructure is there, or will be there. It'll follow. And on the exchange side, we've acted as though we were a regulated entity from the beginning. So we have a regulated rule book, and some of our businesses are in fact regulated now, but in the beginning they weren't. So we built that out. So it's really about trust and integrity, because at the core of what we do, if someone doesn't believe in the integrity of the marketplace, it's over. So, but we're really not really doing anything that's changing the world from an infrastructure perspective. We're really building out and repurposing what we've learned over the last decades, building out market infrastructure. And I think it's there for the most part. There's, it will scale. I don't think it's going to be what's holding back the market at all. It scales quite well.
And building on the infrastructure point, so we've now seen the first CCP labels come out. Some of the concerns that we're hearing from the market is, when is it going to be sufficient supply? So there's obviously a question that's front of mind for everyone there. But also, ICVCM is growing up as an organization and, is moving towards a new operating model. And what does that next phase for ICVCM look like? And when do you think we would sort of approach what would be deemed, sufficient deliverable supply? And as a moving target, I know.
Well, there are a couple things going on. I mean, as Nat said, we're focused on the supply side. VCMI is focused on the demand side, and in between there is the market structure, which John mentioned, and we are going to turn to the market structure issues, not to reinvent anything, because I think John is 100% right. We need to look at, and we will sort of be the organization that brings this together, but we don't own any of these operations, but to really bring together all the right people from the ecosystem, essentially, to say what is it that we need if this really scaled up, right? So what do we need in terms of common trade reporting, and what should that look like? And does every carbon credit have a number similar to an EIN? And the kinds of things that people in the market, and I think this is what John said, people in the capital markets know how to do this for other asset classes. And so we don't need to reinvent this. We need to figure out how to get it to work appropriately in this asset class. And what is it that the market is looking for in that regard? Obviously, interoperability on registries, and do we use a meta registry, or do we, how does that all work? And so I think we have some really interesting conversations that we'll be starting soon on that. I have to say, personally, I can't wait, because that's sort of, when people talk about complicated carbon methodologies, I sort of, I follow it as well as I can. But market structure, this I like. So we're going to get to the fun stuff. So data integration, all those things. But we're also talking about breaking up our work streams into other areas as well. So really looking at, revenue sharing, and do we need disclosure on benefit sharing, and should fee structures sort of converge to a common type of structure? And obviously price transparency is very important. Having all of this pricing information in a system is great, but unless it's transparent, it doesn't really serve the market particularly well. And then we're also thinking about, and this was a suggestion that was actually in our predecessor entity, which was the Task Force on Scaling Voluntary Carbon Markets. One of the things we had talked about there was really seeing if we could catalyze structured finance. We've got an awful lot of small project developers who could probably benefit from finance early on, before the project is really sort of up and running. And could we find ways to bring banks and other lenders together with project developers? And do we need to create even databases on the performance of project developers? Or would it help to have, some sort of platform where lenders and project developers can find each other? So there's a lot of sort of interesting things that we could, look at as well, in addition to the traditional things which we'd expect, which is price transparency, pre-trade, post-trade, all those good things that we're used to seeing in other capital markets.
Thank you. And maybe next year we'll do a panel where we can really nerd out on,
won't that be
on
fun?
financial
Oh, I'm
market
in.
infrastructure. We'll sign you up for it. So building on the climate finance point, Nat, so climate finance can mean different things to different people. But at its core, it is leveraging markets to finance the energy transition. And if we look at some of the key sources of finance, talk real money, we're talking about governments, we're talking about sovereign wealth funds. Like, how do we mobilize that through the VCM today? Or is it mostly going to be mobilized through Article 6? Like, what is that intersection? And maybe also just adding into that, if you could also speak a little bit about sort of your organization's role as a secretariat for the US government and Energy Transition Accelerator, which is another key point of sort of financing.
Yeah, so maybe let me make a couple of sort of general points for context and then fit the ETA into that. The first one is, I say this often when I'm in conversations with people who are more skeptical about the voluntary carbon market. I know that's not necessarily this crowd, but I think it fits here as well. If there's, one thing we don't have enough of is climate finance. And as soon as somebody says, we have enough climate finance in the world, we don't need any more, then I'll stop talking about the VCM and how we build it out. But for now, we just need, we need trillions of dollars of finance. And so we need to be finding it in every place we can. The voluntary carbon market is only a tiny sliver of that. The compliance market, the government, the sovereigns, there's a huge amount of other sources of finance. But I think the voluntary carbon market can be an important source for a couple of reasons. First of all, the estimates that have been done, going back to the estimates for the TSVCM that predated the ICVCM, the estimates that have done suggest, and you can pick your number, but there's clearly potential to get to 5, 10, maybe $20 billion a year in finance in the voluntary carbon market. That's, on the one hand, that's a few orders of magnitude smaller than the need. On the other hand, that's several orders of magnitude bigger than what we have, right? And so if we can mobilize that, how do we do that? So I think there's a really important role. The other distinctive thing I think about the voluntary carbon market, and it's true of carbon credit, I think, finance in general, but especially for the voluntary carbon market, it's a very kind of flexible source of finance, right? If you think about, and I'll take it to the energy sector in a minute, but think about the energy sector, and this will lead up to the Energy Transition Accelerator. But if we're thinking about how do we accelerate decarbonizing the power sector in developing countries, well, look, some of that is, you want to build more renewables, and we kind of know how to, maybe carbon credits can help there, but basically we know how to finance renewable projects. But you also need to build out transmission and distribution, and depending on the model, maybe that might be harder to finance in some places. You need to close coal plants early. That's very hard to finance with traditional finance because there's no financial return. The return is in the reduced carbon emissions, and you need to invest in communities and a just transition, and that's also doesn't earn traditional financial returns. So when you look at an example like that, and you can take others from reducing deforestation and so on, carbon credits can provide a very flexible source of finance. They're performance-based, so you know that you're getting what you're measuring and paying for what you want, which is emissions reductions, but they don't come with the same kind of strings as debt and equity and so on. So it can be very valuable. So then how does this all fit into the ETA? Well, when I think about how do we scale up, like what is needed to scale up the voluntary carbon market, I come up with three things. I think three is always better, and they all start with an I because alliteration, right? So one is integrity. We've talked about that. You need bedrock of integrity in the supply side in particular, and ICVCM is doing that. We talked about demand and markets. The second is you need incentives, right? And the incentives, I think, come from clear rules of the road around appropriate ways and accepted ways for companies to use the credits. And we talked about that as well. I think there's lots of scope in Scope 3 and some other ways. So we just need to have that business case. But the third is innovation. I don't think we're going to reach the kind of scale I mentioned, which is 5, 10, 20 more billion dollars a year, if we don't have innovative ways to really reach that. So I don't think we're going to do it just sort of with the same old kind of methodology we've used. So there's two ways to think about that, which are not mutually exclusive. One is, how do we respond? How does the market respond to what ICVCM is saying about here are the clear rules of the road or the principles around core carbon principles, how does the market develop new methodologies quickly that will meet those principles and can meet the CCPs and scale up? Because a lot of the methodologies we have in the market were just written when we didn't have advantage of the knowledge we have now. And so to close that supply gap, we're going to need innovation there. And then finally, the ETA, the other source of innovation, I think, is thinking about emissions reductions at scale and thinking about ways to bring sovereigns into supporting voluntary carbon market initiatives where the demand comes in part from companies that are thinking about their own climate commitments, but maybe also bring in demand from sovereigns or support from sovereigns in some way. Those of you who know about tropical forests will know of the LEAF Coalition, which is a sort of pioneering model of this, jurisdictional scale crediting for reducing emissions from deforestation that the US and the UK and Germany were involved in. The Energy Transition Accelerator is also supported by the US government, as well as Bezos Earth Fund and the Rockefeller Foundation. And the goal is to build a coalition of buyers, many of whom will be companies, we anticipate, on the voluntary market, and sellers, which would be countries that are looking to accelerate their transition. A coalition of buyers and sellers to basically create a market for innovative carbon credits that can provide scale, that can provide finance at scale to help accelerate that decarbonization, and they could do that across the board. So, sometimes people talk about transition credits. I was just at a talk, and I was just giving a talk at Rockefeller about this. Part of that is the coal plant transition, but part of it is also investing in distribution and transmission and investing in renewables and so on. And so one of the innovative things about ETA is to look at the whole system and think about how could we build a carbon crediting system, including perhaps with a standard or with, thinking about how to amalgamate standards, but how could you have an approach that takes a jurisdictional view? And so building a buyer-seller coalition, looking to really accelerate finance using carbon credit markets for the power sector transition in developing countries, and thinking about a jurisdictional scale. Those are sort of the innovations we're trying to bring to that area. And the hope is to be mobilizing, again, billions of dollars a year in finance to cut emissions and to support the just, clean transition.
Thank you. And John, building on the role of sovereigns within this space, how important is the integration of the VCM with national mitigation efforts in order to achieve meaningful climate finance? And what do you see as the role of governments or national markets within the VCM, or interacting with the VCM, I should say?
Yeah, maybe just pull back for a second too on the VCM. It's been noted a couple times how this VCM's small right now, and it needs to be much bigger. I think really we're at the beginning. All right, we're fundamentally talking about changing the way the world uses energy. That's what has to happen, and the VCM is one tool in that, and it's a tool that proves out new methodologies, new things, and sometimes it'll make mistakes, but it's a proving ground where we can do lots of stuff, innovate, deploy capital in new ways. Someone has a new idea about some technology or whatever it may be to deploy, and it fundamentally just really creates that opportunity. So we're all here in the first inning of the game, and not some of us have been around for a long time. And I would pull back to the renewable side, to pull back to the ETA and some of the stuff that's being done there. I was working in the first renewable energy credit markets. We set the first registry up for them in the world. There were a couple different models that were tried: feed-in tariffs in Europe and REC models in the U.S., and obviously there's tax credits. But in the early days, it was really just small, very small. It was basically Whole Foods wanted to put up a sign saying that they were 100% wind power, and a couple other forward-leaning companies. And then all of a sudden, it got proven out, and then it started in Texas. It was the first renewable portfolio standard, which most people don't guess it would have been Texas that would have led the way on that. And then it kind of stamped around the country. And then you started seeing governors go, we're going to go 5% renewables. And then they were like 7%. And then they were in a room basically like, I'm going to do 10. And it was sort of this almost like a euphoria going around. And it proved itself out. And in I think many ways, a lot cheaper than anyone thought it would be, because you have a mechanism to deploy cash. So kind of saying that piece and then saying, well, what does it mean from the sovereign's perspective? Yes, they're obviously the ones that have the capital, the key programs, just really showing confidence in being able to buy. So if you could say this works for the the EU markets, but also if there's like the sovereigns of Norway, where Henrik's from, if they come in and buy, and they're buying something and it shows that this is good enough. Because the corporates, the one thing that the corporates, and we see it over and over again, the corporates deal with is they wake up in the morning, their fear is they want to wake up in the morning and have an article written about them doing something, buying a bad credit. None of them want to buy bad credits. So the idea of being fearful of that, they need some protection, and I think it's the great work that ICVCM's doing, the VCMI and others, to really help protect that. But if we don't solve for that, those companies are just going to sit on the sideline and kind of barely dabble in.
And that, going back to sort of financial market infrastructure, if we look at any market that has been successful in scaling, there's a high degree of standardization.
Yes.
And you pool liquidity together, and that's really how you grow markets. And that's not where energy transition markets are today, broadly speaking. How do we ensure that we move towards that standardization and that pooling of liquidity, especially in a situation where you have national markets that are coming up and different countries wanting to do things in different ways? How do we move that forward?
Well, we certainly want to, from a market structure perspective, encourage it, right? I mean, today there really is very little trading on exchanges. It's an overwhelmingly bilateral market with individually negotiated contracts. But I think if we get more standardized terms, more trading on exchanges, I think what you'll find is that that's going to really improve the buyer experience, because they're also going to know what they're getting if the product has a CCP label. So I would think that if you build it, they will come. I mean, it's not something that we're mandating on standardization, but I believe that that's going to be in everyone's interest. I also think some say even the CFTC's guidance might help push us more, towards greater standardization. So all of these things, I think, are likely to happen and would be welcomed if they happen. And then again, as you say, if you're talking about working with nations in Article 6, again, the more standardized this is, the more seamless that process would be, I would assume.
And Nat, do you see a growing potential conflict between national markets and private markets with all of the different national initiatives that are coming up? I mean, we're getting very close to the third round of climate pledges next year, and the second stock take. How is this all gonna? Is this all going to come together, or are we going to have a number of competing initiatives at different levels?
Well, I think briefly. I mean, first of all, it's as somebody who thinks a lot about U.S. policy, has been involved in U.S. policy. Obviously, the U.S. is increasingly an outlier here. I'd love to say that the U.S. is going to move to having a federal national sort of market pretty soon, but I don't see that happening, unfortunately, anytime soon. So I think in the U.S., I think the voluntary market, if we can figure out some of the rules we've been talking about, especially and the norms and the business case on the demand side, I think that will be a pretty robust market in the near term for the U.S. I think elsewhere, what's really fascinating is to start to see the convergence. I think it's more a story about convergence rather than kind of competition. So look at Singapore, for example, which has, as folks know, is instituting a carbon tax, but will allow companies to comply with the tax by using an approved carbon credit. So is that credit, now that credit might be sourced from projects, and they're developing principles, and they're talking to ICVCM, and so I think you'll see the alignment there. So is that a voluntary credit? Well, no, because it's being used for the compliance regime in Singapore, but it might come out of the same pool and might even meet the same standards as the voluntary market. And so that begins to look like convergence. And I think that's a good thing, because the work of the ICVCM can inform the work of regulators who are thinking about how to tap into the carbon markets out there, and then that in turn can provide demand and ensure we sort of raise standards. So I think there's going to be interesting convergence between those kind of compliance mechanisms and what we think of now as the voluntary carbon market, which maybe we need another word other than voluntary, because some of that, because it'll be the use cases. Daniel Clear of South Pole was telling me this the other day. With the use cases, some of them will be voluntary, some of them might be compliance, but it's going to be, I think, increasingly from a pool of credits and generated by projects and programs that need to meet a common set of quality standards.
And John, finally, before we go to audience questions, I mean, if you look at from your seat the energy transition and all of the myriad of different initiatives and national markets and everything coming up, and we try to look beyond carbon, what are some of the new energy transition asset classes that you see emerging and are going to be important in meeting these climate finance goals?
Yeah. Well, I mean, I think definitely renewables are having their day in the sun, quite literally. You're seeing it happen around the world, where you see a massive driver to move to renewable energy on the electric grid, and I think that's in flight and is going in the right direction. I think the big area that's next is fuels, and how do you transform fuels? So that goes everything from nat gas to differentiating oil on the way out, those types of things. Obviously, sustainable aviation fuel was talked about earlier, but we're fundamentally, again, changing the way we use energy. We need to think broad. I think it's a real mistake when we focus on just the VCM or just renewables, or we do stuff in other areas in fuels. If we just focus on that, and it's not that, it's not one against the other. In reality, we need to do it all and then more. But I definitely think the one area that's not being talked as much about is the fuels area. I think it has the opportunity to be a huge marketplace, but also very transformative as we change the way particularly transportation fuels.
Thank you. So we're going to open it up for questions. Nat has informed me that he needs to be somewhere, I think, 3:30. And there's an 8-minute city bike ride down to Bryant Park. So if you can raise your hand, there's going to be a microphone coming around. Please just state where you're from and who your question is to.
Hi, my name is Cole. I'm a reporter at Argus Media. I had a question for Nat, so happy to get you before your bike ride. Can you speak to, with the Energy Transition Accelerator, what the near-term plans are? Do you have any plans for announcements at COP or later this year? Or what's the next phase for it?
Sure. I think the core we're focused on now is building the coalition. So we continue to get to bring in companies that we're working with sort of on the buyer side. I think we'll be announcing something tomorrow in terms of how that coalition has grown, but it continues to grow. I think in terms of the seller side, on the countries, last year at COP we announced Chile, Dominican Republic, and Nigeria as pilot countries, and then in the Earth Day of this year, the Philippines came on as an observer. I think where we're looking to for COP this year is with that group of countries, demonstrating the kind of progress that they've been able to make. We've been hard at work. The World Bank is a close partner, helping with technical capacity, helping to sort of do some of the economic analysis and modeling and understand what would it look like, what would the investment plans need to be, and so on. And then, as we look ahead to next year, as we announced also last year, the Environmental Resource Trust. I know Mary Grady was here. I don't know if she's probably jetted off to something else. But ERT of Windrock International is being supported by the partners to develop an independent standard, a jurisdictional crediting standard. So we expect that's Mary's team, but we expect that to be out next year, and that's something that ETA would look very closely at. There are also some other crediting standards coming out, and ETA will be evaluating those against the criteria that we put out in our framework last year. So a lot of it is head down building the coalition. I mean, because what we're really looking to do is be able to create kind of a community of buyers and sellers that are working to create this market. But we're very much focused. John Kerry has come on as obviously he was instrumental in starting it when he was the Special Presidential Envoy for Climate in the State Department, and now that he's left state, he continues to be involved. He's the honorary chair of our senior consultative group. And I will tell you, every conversation I have with Secretary Kerry is about the urgency and the need to get going. So if ever we forget the importance of getting this going and underway, we have Secretary Kerry to remind us. So a number of things going on, but a lot of work has been happening kind of to build that coalition, and we expect to continue to be doing that going forward.
Perfect, thank you. More questions? I think there's a question in the back.
I also a pointed question for Nat, so glad to catch you before you go. I'm Naomi. I'm with Ion Group. I'm just wondering how you're thinking about mobilizing the military and the DoD in the VCM, as now there's kind of greater regard for climate change as a threat multiplier for national security, and perhaps positioning the military and DoD as a major player in the market.
So that's a really interesting question. I will say right up front, we have not thought about that in the context. Certainly, I have not had any conversations with our partners, with the ETA partners or the Department of State about that. So I don't. There's nothing in, no conversations happening. Having said that, it's a very interesting point. I mean, as somebody who's been involved in U.S. policy, in U.S. climate policy for a number of years, obviously the growth of awareness in the U.S., in the Department of Defense, the Pentagon, I mean, particularly under President Obama also, but I think that was the growth, and now we see that under President Biden. I think that's been striking, and the realization that the military, not only its huge procurement power, but more importantly, that the military operationally in the field needs technologies that don't leave this enormous fuel supply line. They need more sustainable fuels for the Ray Mabus, when he was the Secretary of the Navy, was really a leader in sustainable fuels. So I think the military and I think the Department of Defense, the Pentagon has done a lot of interesting thinking. We haven't brought them into that conversation about the market, but it's an interesting question. So maybe we'll take that back. But I think overall, certainly from a broader climate point of view, not necessarily the ETA or the VCM, but I think from a climate point of view, there's such a clear connection between national security issues and climate that I think it's a natural they're a natural group to bring in.
Thank you. Any more questions? See, there's a question up front.
Apologies for asking so many questions today, but we're privileged to have some great people here, and thank you for Xpansiv for putting this together. Annette, we're also privileged to have somebody of your stature involved in the carbon markets. And given your experience at SEC, Chairman Gensler has been making a push on carbon, but he's received some pushback. One of the drivers of supporting the project-based carbon market would be some kind of action around the risk that is not, on the books or off the books. But climate and carbon risk is probably the biggest unhedged risk for public corporations. What do you see the SEC doing going forward?
Well, as you know, the SEC has tried to do quite a bit around disclosure in this area, and has run into some headwinds. They are being sued at every turn based on objections to their authority to do climate disclosure. The argument being that, they're authorized to do financial disclosure, but climate disclosure is not financial disclosure. As you point out, climate risk can have a very significant risk to your financial well-being. So that's been a problem. I think we're hearing of, about more, again, private sector efforts to get more data out there that will enable the public to understand what the risks are for various companies based on the business that they're in and data that is currently out there. I worry about the fact that information that's sort of scraped from, today from financial statements isn't necessarily consistent enough that it's helpful, but it's not as helpful as it would be if there was a uniform disclosure requirement. And that was what the SEC was trying to do, was to get the disclosure in a uniform format so that you could compare apples to apples. So I think it's tougher now for investors and for the public to understand, from one entity to the other what the risks are. But I do think we probably have the ability, even without the mandated disclosure. There are a lot of very clever people out there who are figuring out how to bring all this data together from existing documents to get a better sense of where the risk is. And then we have to figure out how to price that risk into the markets, right?
Perfect, thank you. I think we have time for one last short question, if there's anyone. If there's one right there in the middle.
Good afternoon. My name is Clemens. I'm from Austria, and I would like to ask a question to Annette. My question is about additionality and the focus of ICVCM on this topic. So I have the impression, this is also my question, is that ICVCM is more or less solely focusing on financial additionality in its assessment of projects and project categories. And I'm wondering if this was clear that during CDM, when there were countries which had, let's say, mitigation targets and countries which had not, that it was important also from an environmental point of view to assess additionality. But now, when we're in a time when basically the whole world has mitigation targets, additionality is more a concept of economic efficiency anymore, because if we trade ITMOs, we have a clear greenhouse gas accounting all over the world. So when you look now at the project types which have been perceived, or which are now being perceived or assessed as being highly providing high integrity, these are, for example, landfill gas projects where you destroy landfill gas, where you destroy ODS, or leak detection programs. 15 years ago, these project types, so fugitive emission projects, were perceived as low integrity projects because they would say to create perverse incentives because they are only end-of-pipe technologies, and in environmental policies you would rather incentivize project types which provide co-benefits. That was also the reason why a gold standard was created with renewable energy and energy efficiency. So my question is now, what will be the future of this? Because, from a project development point of view, it's difficult. 15 years ago, one category was well perceived, now another category, maybe in 5 years, again, something different.
Thank you. Not necessarily a short question, but...
No. Well, I can give a short answer because I'm not the world's expert on additionality, but I can tell you that those issues were, as you can imagine, very heavily discussed and debated among the experts on our panel, and also among the board members with the presentations we were given. But what is very clear to me is that additionality is a very difficult issue, and one that requires a lot more additional thought. And one of our major continuous improvement work programs is on additionality, how to really look at this issue based on what we have today as the best science, best practice, and how do we improve upon that. And that is something that folks are spending a lot of time on. And that's true with a number of our, not on the principles, but the assessment of the principles, that we have a number of work streams. We have 10 continuous improvement work programs, whether it's additionality, permanence, sustainable development, a number of issues where we knew we had to get started with where we are today and the best understanding and science that we have today, but we know that we have to be better. And we have committed to that every 2 to 3 years we will be reassessing the assessment framework and improving it to the extent possible. Actually, one of the things that we've thought about very recently, which I thought was a great idea, one of the problems here is we want to rely on sort of the best academic thought that's out there and the papers and the science. And there's a shortage on a lot of that. So as we are now coming up with more questions and actually having some frustration with the lack of academic research out there, I think we're going to start to make a list and start to publish. And I think we're going to come up with phenomenal topics for PhDs going forward, because there'll be a real tangible need for more work in a lot of these areas. Perfect. So thank you for the question.
So thank you, and we'll call it there. Nat, we'll let you get on your bike. And so thank you to Annette, Nat, and John, and please join me in thanking the panel.